All right, let's dive right into this explainer. Today, we're going to build a absolutely bulletproof mental model of how the world actually works. We're going to connect the dots from your morning cup of coffee all the way up to massively complex global supply chains. Because here's the thing, once you truly grasp economics, the world stops looking like this confusing, random mess. It actually starts looking like an incredibly fascinating, interconnected system. You're going to see exactly why certain policies completely fail, why things cost what they do, and honestly, how you can make vastly better decisions in your own everyday life.
So, here's our blueprint for today. 1. The problem of scarcity. 2. Opportunity cost and trade. 3. Prices are hidden messages. 4. The cost of intervention. And finally, 5. The macro big picture. We're building this from the ground up, starting with scarcity and zooming all the way out to the entire economy. Let's get to it. Section 1. The problem of scarcity. The economics foundation. Let's see how this one concept builds the absolute foundation of literally everything else we're going to talk about today. You know, when most people hear the word economics, they immediately picture like guys in bow ties staring at stock charts or these mind-numbing spreadsheets about money. But honestly, economics is not fundamentally about money or getting rich. It's actually the study of human behavior. It's the study of people. Specifically, it's about the choices you and I are forced to make when we realize we just can't have everything we want. And why exactly can't we have everything we want? Well, it boils down to scarcity. Think about it. You're human. You want stuff. You want food. You want shelter. And yeah, you probably want a slightly larger TV than your cousin has. We all have virtually unlimited wants, but the world? The world has very limited resources. There isn't infinite pizza, there aren't infinite TVs, and there definitely isn't infinite time. Actually, if there were infinite pizza, economics wouldn't even need to exist. But because there isn't, every single action we take requires making a choice. Moving right along to Section 2, Opportunity Cost and Trade, the hidden price tags. Because we can't have it all, every choice we make comes with a hidden cost. Let's talk about opportunity cost. The true cost of something isn't just the cash you hand over to the cashier. It's whatever you had to give up to get it. Imagine you go out and buy a beautiful, brand new BMW for $50,000. You feel amazing, right? But what did that car really cost you? If you had bought, say, a super reliable Toyota Corolla for 20 grand instead and invested that $30,000 difference, well, in 30 years, that money could have grown to almost $250,000. So, no, that BMW didn't just cost $50,000. Your opportunity cost was $250,000 in lost potential. Every time you spend $1, or even just an hour of your time, you are giving up what else that resource could have become. Okay, so we have limited resources and we're forced to choose. What is our best survival strategy here? We trade. But wait, think about this for a second. If I trade you half my sandwich for a slice of your pizza, the total amount of food sitting on the table didn't change at all. So why on earth did we do it? We did it because we both value what the other person has more than what we just gave up. It's kind of magical. Trade creates value out of thin air without actually creating any more physical stuff. And this brilliantly illustrates the whole concept of comparative advantage. Let's say you're a highly paid lawyer pulling in $300 an hour, and you also happen to be incredibly fast at cleaning. Should you clean your own office? Absolutely not. Even if you are literally the best cleaner in the world, the opportunity cost of your time is just way too high. You pay a cleaner $20 an hour, and you use that saved hour to make $300 doing legal work. Boom, you are both way ahead. Doubling down on your strengths minimizes those hidden costs and makes everyone richer. And this works exactly the same way for entire countries, like Brazil specializing in exporting coffee, while Canada exports corn. Let's hit Section 3. Prices are hidden messages. The invisible superhighway. Now that we've seen how two people, or even two countries, trade, how do millions of humans coordinate their daily lives without a boss telling them what to do? There's this incredibly famous story where the Soviet leader Mikhail Gorbachev visited Britain, and he asked Prime Minister Margaret Thatcher, "How do you make sure people get food?" Her reply was stunningly simple. She just said, "I don't. Prices do." Think about a massive city like London. Millions of people needing 3 meals a day. There is no minister of sandwiches deciding where the bread goes. Yet somehow, every single morning, coffee arrives from Brazil, and fish arrives from Norway. An invisible information superhighway handles the whole shebang automatically. And that superhighway? It is run entirely by prices. Prices aren't just arbitrary numbers slapped on a tag. They are instant, honest messages. If there's a sudden shortage of pizza, the price shoots up. That higher price acts like a flashing siren to suppliers saying, hey, rush in, make more pizza. When there's too much, the price drops, telling them to slow down. Literally, no human brain or supercomputer could ever calculate the millions of variables needed to feed a city, but the pricing system, it does it flawlessly, every single day. Let's translate these price messages into human terms, profit and loss. Imagine a middle school lunchroom where you bring in extra fruit snacks to trade. The kids absolutely love them, and you make a profit. That profit is the market's way of telling you, yes, society wants this, do it more. But what if you bring in boxes of raisins and literally nobody wants them? You take a loss. Now it hurts, but that loss is incredibly valuable feedback. It's basically society screaming at you, stop wasting resources on things people don't want. Both profits and losses are strictly necessary for the whole system to learn and adapt. So here's a crucial point to remember. Your wage is just a price too. It's simply the price for your labor. Say you run a lemonade stand and you hire your fast, super friendly friend Maria. If she helps you sell $10 extra worth of lemonade an hour, you can pay her up to $10. But if you hire your slower friend Jake, who keeps spilling things and only adds $2 in sales, paying him more than $2 means you're going to go out of business. It isn't mean, it's just math. A boss doesn't pay you for your time. They pay for the value and the results you generate for the market. On to Section 4, the cost of intervention, breaking the system. So what actually happens when governments or politicians look at this super delicate messaging system and decide, you know what, I don't like the messages prices are sending? Whenever we try to intervene, we have to remember the ultimate golden rule of economics. People respond to rewards, not intentions. Back in 2008, Maryland wanted more tax revenue, so they decided to raise taxes on millionaires, fully intending to collect an extra $106 million. Well, instead, they lost over $250 million. Why? Because they unintentionally rewarded those millionaires for just leaving the state. Or how about when colonial Vietnam offered a cash bounty on rat tails to reduce the rat population? People just cut the tails off and started breeding more rats to make more money. Intentions really don't matter, incentives do. This slide perfectly illustrates what happens when you try to break the pricing system using price controls. If you legally set a price artificially low, you get a massive shortage. New York City rent control causes landlords to literally abandon buildings because they can't even afford the basic repairs, leading to empty apartments in a city struggling with homelessness. In Zimbabwe, food price caps led to farmers just keeping their crops, totally emptying grocery stores. On the flip side, if you set the price too high, like India guaranteeing high prices for wheat, farmers overproduce. Millions of tons of wheat just sat there rotting in warehouses while people elsewhere starved. Bottom line, break the price and you break the entire system. And finally, Section 5, the macro big picture, the global economy. Let's pull the lens way back. We've looked at individuals, we've looked at trades and cities. Now, let's zoom out to look at the entire global economy. Economics is basically divided into two distinct halves. Microeconomics is what we've been doing so far, looking at how a single business decides to hire a worker or how you choose between buying a burger or a movie ticket. If economics were biology, micro is like studying a single cell under a microscope. Macroeconomics, on the other hand, is studying the entire ecosystem, the whole nation's output, unemployment rates, and inflation. I want you to think of the macroeconomy as this giant, incredibly complex, global Rube Goldberg machine. Let's trace something simple, like a $14 avocado toast. It requires land, which means natural resources like the actual avocados and the wheat. It requires labor, the human effort of the people planting seeds and driving trucks. And it requires capital, the man-made tools like tractors and shiny espresso machines. You feed land, labor, and capital into this machine, and it spits out an economic output. So to measure how well that giant machine is running for an entire country, we use a metric called GDP, or Gross Domestic Product. Think of it as a massive calculator that just adds up absolutely everything a country produces in a given year. It adds up all the consumption from everyday people buying stuff, the investments made by businesses, government spending on public goods like roads and schools, and whatever we export to other countries, minus the things we import. But there is a huge, dangerous trap at the macro level. See, money is really just a unit of account. If a central bank decides to print a ton of new money, but the actual physical output of goods, the stuff coming out of our Rube Goldberg machine, stays exactly the same, you get inflation. It's simply more money chasing the exact same amount of stuff, so the prices of that stuff naturally have to go up. If this is done recklessly, you get hyperinflation. Take Zimbabwe in 2008, which hit an unfathomable 89.7 sectillion% inflation. The prices rise so incredibly fast that your wallet basically catches fire before you can even cross the street to buy lunch. Whether a country is operating under free market capitalism, a strict command economy, or, like most of the modern world, a mixed economy, every single system on planet Earth is really just trying to answer the same three basic questions. What do we make? How do we make it? And who actually gets it? And honestly, no one has nailed it perfectly because every single system has massive trade-offs. Free markets are unbelievable for driving innovation, but they can create inequality, while heavily planned economies aim for total equality, but often end up destroying the very incentives to produce anything at all.
Well, we've built this mental model all the way from the ground up. We moved from the hard reality of scarcity all the way out to global trade. You've seen that prices are honest messages, that incentives completely dictate human behavior, and that absolutely every choice carries a hidden cost. So, I'm going to leave you with this provocative thought to apply to your own life today. Now that you know you can't have it all, what are your daily choices truly costing you? Double down on your strengths, respect the trade-offs, and you'll navigate your world with absolute clarity. Thanks so much for joining me on this explainer, and I'll catch you in the next one.